a special focus right here on Equity Access, your daily insight on stock market developments and on developments in the Zimbabwean economy. A beautiful evening it is to you. I'm Ibn Mabunda. Let's roll. On agenda tonight, Zimstats today published inflation figures for the month of January 2019. Well, inflation is up 56.9% on a year-on-year basis, while it is up 10% on a month-to-month basis. This stands very much apart from what government has predicted or is expecting to be reflecting in the economy. Well, if we're to have a look at what the minister said, he said that he expects a single-digit inflation figure by December. Let's have a listen to his conversation that he had with one of the reporters while he was in Davos.
For December, we're expecting an inflation that is single-digit indeed, but it will take a few months naturally to get there. Part of it is technical in the sense that we're coming from a low base, and then with the sharp hike in prices in October 2017, that has moved us to a higher level of the index, and that creates a technically higher figure for inflation. But if you look at month on month, the inflation figure is actually single-digit. It's actually 9% for the last 2 months at least.
Well, you heard what the minister said. Let's have a quick look at the stats. Inflation for the month of October was 25%. Inflation for November was 31%. For December, that very same inflation was 42%. Now, in January, we are up at 56.9%. Now, there is very much of a discrepancy between what the minister has said and what we're seeing playing out. Well, Equity Access investors did tweet on the 17th of January that they expected inflation for January to be above 50%, and that has played out exactly like that. Now, it goes out to be seen how things will play out as the economy progresses with the year. Of great anticipation is the presentation of the monetary policy statement by the RBZ governor, which is now 2 weeks long overdue. Well, questions could be asked as to why the delay. Perhaps there are things taking place in that cooking pot. Elsewhere, London-listed Vast Resources has been given a diamond mining license through its joint venture partner, Red Mercury. Well, Red Mercury is owned by the Marange Zimunya Community Trust. And in that engagement, they have a diamond mining opportunity to mine what is known as the Heritage Concession Area. Last year, the Zimunya and Marange Diamond Organization engaged in a diamond treaty to mine together with Vast Resources. Of course, this then means that Vast becomes the third company in that same bracket alongside Chinese Anjin, as well as Alrosa, which is the world's leading diamond producer. So this, of course, is in line with government's target to produce 4.1 million carats by year end and to produce 10 million carats by 2023. Let's have a quick look at the stats. Well, this is 2010, we had 8.4 million carats. 2012, 12.1 million carats, which is the highest that we have ever produced to this point. This is the time where we are getting those alluvial deposits in that regard. We get to 2015, the government seizes all mining engagements in that regard. And so our figures are on a decline. In 2016, there we produced 2.1 million carats. Then 2017, 2.5 million carats. And our government has targeted a figure of 4.1 million carats. What government has also done is they have now allowed foreign companies to have a shareholding that is beyond 49%. So perhaps with those policy shifts, perhaps we could be moving towards the 2023 targets of producing 10 million carats in that sense. Meanwhile, SA giant Countrybird Holdings, the franchisee of local KFC, has decided to invest $150 million in Zimbabwe towards the farming of poultry products in the country. Of note is that this project is expected to see the employment of 1,500 Zimbabweans. At the same time, it's also vital to highlight the fact that the country has 16 years experience in this field, having been established in 2003. Furthermore, the country is also in operation across the SADC region as well as Nigeria, making up 7 countries. So this, of course, is a move to expand its operations in the country in that poultry farming, as well as enhance their operations in KFC. Just for your own interest, CBH produces more than 500,000 tons of feed per year, as well as produces 150,000 tons of frozen chicken per year. Well, juxtaposed to Zimbabwe, Zimbabwe produces 144,000 tons of chicken annually. So with the coming in of CBH, we could see an interesting change in the matrix of poultry in the country. And of course, we cannot ignore the effect that this would have on the fast foods industry. For a conversation on these and other issues, I'm joined in studio by our resident investment analyst, Anesu Chimbumu. Anesu, good evening and welcome to the platform.
Well, thank you, Eben. How are you doing today yourself?
I'm great. That's beautiful. Let's cut to the chase. Inflation figures out 56.9%, coming from 42% in the previous month.
Yes.
What is your interpretation of this?
It's a very worrying figure, and especially with the minister actually saying that he's expecting a single-digit in inflation rate by December. It is pretty worrying because as of now, the inflation rate has accelerated. If we could just go into it, we do know that our inflation problems really started emanating, or rather, we started seeing the fruits of our misfortunes from the past in October, as we started doing the 25% about this time around here, this point here, and then the 25% went up by about I think it was close to about 50% when it shot up from September to October, and then October to November was a 9%, and then November into December was another 9%. It was pretty stable, but then had it continued, we could then say probably Mtuli has some sort of idea or plan that is actually beginning to show fruit. But then this month it has come up 10.4%, which shows that there's an acceleration within the inflation rate on a month-on-month basis. Okay. So now that begins to really...
Acceleration, you said?
Yes, because we've come from a 9% growth rate, which had happened for about 2 months prior to this. Now it's about 10.4% extra now. So that shows a level of inflation that is now beginning to get into a place where we could start really saying we are in a hyperinflation period, because from 9% to 10.4% on a month-on-month basis is not very comforting, especially with what he's targeting. Remember, he did say that in the TSP and the budget, he's targeting an inflation rate of about 5% in this year, and it is looking even more gloomier, because at the rate of growth for the inflation rate has something to do also with the fuel price increase that happened just before the road to Davos trip for 2019. So with that being said, we are still expecting more and more of these issues, because we still don't have a solution that is very much solid for the fuel side of things, and production is becoming hampered. So now with production becoming hampered, we are also putting our country at a place of risk where the trade deficit is also going to be increasing, because the trade deficit also has an implication and an addition to all of this, because when we do import more, we then bring in the cost of the parallel exchange rate that is actually on the ground, rather than the 1:1 issue. So for him to actually
hold on a second. Hold on a second. The minister seems very much confident of what's actually happening.
Yes.
The minister is boasting of increased revenue through the 2% tax.
Yes.
And of late, Zimbabwe has been generating $50 million per month. Okay? And in as far as the minister is concerned, we've been achieving fiscal consolidation over the past few months. So if we are to go by what he says, I'd forgotten something else. In addition, just 3 days back, the minister was also speaking to a group of military men. And he said, look, by the year end, we should have achieved a single-digit inflation. So he seems very much confident, but you seem to be communicating a different story as much as the figures.
Well, 'cause we need to very much realize that the problem of inflation is not just an issue of people just raising their prices. There are fundamentals that are very much wrong in the country.
Fundamentals is exactly the language of the minister.
Yes, and those fundamentals need to be addressed. One of the fundamentals that I think are is very key is the 1:1 rate. That 1:1 rate needs to be relaxed or needs to be put in a more controlled relaxation, which is semi-fixed. You know, just like Nigeria, I've been really liking the Nigerian model,
Okay.
but then with him not fixing those fundamentals, with them not being able to tame the government spending and all of those other fundamentals that are not in place, we do not have a correct handle on what we call inflation, because our trade deficit has been increasing. If you check for trade deficit for the full year of 2018, it was up 50% to 2.5 billion from 1.8 billion in 2017. And now, as it has been going on a month-on-month basis, inflation has been going up on a plus 10%. The trade deficit on a month-on-month basis has been going up almost by 10%, almost. So you'll see that with things getting even much more tougher, production being reduced. One of the reasons for our trade deficit being increasing is because our exports have been going down. You do see your gold mines have been closing as of late. People are no longer small scale miners have been producing less of what they have been usually producing as of late. Yes, gold did improve on a month-on-month basis coming from December into January, but then that is not viable enough for an economy to start talking about us really reducing this rate of increase coming down to 5% by the time we hit December.
Okay, hold on a second. You mentioned something to do with the 1:1 exchange rate. And this is ahead of the presentation of the monetary policy statement by the RBZ's Governor Dr. John Mangunjuka. What do you think we could expect, or what do you think perhaps would be the right course of action in order for us to be able to draw ourselves out of this quagmire?
1:1 rate is one thing, and then also the currency issue is something that they should face now, or if they do face it later, they need to have a very solid plan.
Could that be perhaps the reason for the delay? I mean, this should have been published by January.
I wouldn't really know why they're delaying the release of the monetary policy.
The complexity of the situation?
It could be. I can't really comment much on that,
or
because
that could be fixing and putting things in order to come up with the best solution.
It could be. We never know, and only until they then say something.
So what?
It will be, because we can only take them for the word that they've been only mentioning as of late. And him aiming a 5% inflation rate by December, I don't think it's going to be very much possible. Him aiming that budgetary, but the budgetary inflation rate that he mentioned, which is about 5-6%, it is not possible at the current rate, because for this peak to come down, there's a lot of work that needs to be done. There's a lot of production that needs to come into play.
A lot of work that needs to be done from the monetary side. What can be done?
From the monetary side, we need to deal with the forex issue that is at hand. The forex issue needs to be trimmed down by ensuring that there's production that is now being.
How could we do that?
This is what I'm saying. If we relax the 1:1 rate,
okay,
right, there is going to be some truth in what people are actually producing and making.
Okay.
Right? When they do have truth in that, then we know where we are going.
Right.
Then producers can actually make real profits,
okay,
and come back to a place where they can say, okay, if for me to make this much profit, I need to produce this much. I need to be able to grow at this rate for me to reach these targets. And if those targets are not set, are not achievable in a place where we have an exchange rate that is fixed and is very much of a fallacy, it is not very good for any business sense. For any business sense. So that kind of 1:1 rate is bringing in costs that are unfathomable for most of these businessmen, and they end up having to close because they can't actually access that foreign currency
Right.
because people who have the foreign currency outside can bring it in at a 1:1 rate. They can't. You can't simply import for foreign exchange on a 1:1 rate when it is not true.
Moving on, Anes.
Well, sorry. It's just a last pointer for people to really understand that even with the trade deficit right now, like I had mentioned, that it had hit the 2.5 billion by the year end.
Okay.
And what we need to do also is to make sure that that trade deficit really starts coming down. But then that only comes in a place where we actually start really pushing our exports and making sure that those who are exporting are really being incentivized in a way that they can keep on producing more and more. Because for us to really cut down on our imports right now, it may be very much difficult because most of the products that are on our shelves right now are imported, and the fuel that we so much need is imported, and we cannot do away with most of the imports right now. But then as time goes on, with us pushing our exports, we can then really start taking out some of the stuff that's on the shelves. I mean, we did notice that there were new brands of cooking oil that was now coming up on the shelves as time went on, when things were getting a little bit better, when the trade deficit was actually slimming down from your 2014s, 2015s, and 2016 and 17.
So what happens if the gap is not closed?
If the gap is not closed, we're gonna keep on expanding that gap. That gap is gonna keep on growing much bigger, and there's gonna be more need for foreign currency. There's gonna be pressure from the foreign currency side of things. Is gonna start pushing up costs, because most of these companies that do operate would need to import some of these products, and for them to import, they need to buy that foreign currency. And with this scarcity in the country right now, they'll end up buying that foreign currency at a premium, or have to find other ways.
Okay, let's move on to our next story. London-listed Vast Resources just acquired a diamond mining license through Red Mercury, which is owned by the Marange Zimunya Community Trust. Mm-hmm. Well, what does this mean for Zimbabwe going forward in as far as our production?
I think it's a very positive thing, because as you can see, we've come from a place where we were doing about 12 million, right about here, and then it came down to about 2.1 here, and then we've somewhat come back up to 2.5 here. And this here is about an 80% decline.
Okay.
Right? So this 80% decline here was not very good, and that meant less forex coming into the country, which is not very good, as we can see the results of such a thing. So now with Red Mercury being in partnership with Vast Resources, now being able to now mine, courtesy also to a new diamond mining policy that did come out, where foreign companies can now have a controlling ownership over a mine. But then this really gives us a lot of hope, because what I think was the major problem around about this area when we were doing very bad numbers is because of we didn't have any mechanization for us to really do a lot of exploration, and also alluvial mining wasn't doing much for us anymore. So we needed to get into a space where we start going deeper and have more explorations of other areas that we could actually get the mineral from.
Hold on a second, Anesu. What happened between 2012 and 2016?
Basically, lack of accountability. Because we then find out later on, as we were coming closer to the finish of this decade, that there was some sort of looting that had been happening from the miners that were there. So as time went on, they started repatriating less and less and less of what they were actually mining. So lack of accountability is the major cause here. But then now that we have Zimunya Marange trust in within the deal through Red Mercury, then we can really find a place where we can have some comfort of accountability being there, because we have a company that is very much interested in the well-being and the improvement of the country. So with them being there, there is some sort of accountability that is going to be taking place.
Okay, moving on, Anesu. SA Giant Country Bird Holdings, that we know that has been operating KFC, is now investing $150 million into this economy with a target towards poultry production. Right now, my question is, we've seen these guys on the market, we've seen them run the KFC franchise locally. But my question then is, why are they deciding to get into the birds aspect of things in terms of farming?
Okay, even as you've rightly mentioned, CBH has been in business with Zimbabwe currently via KFC. And us as Zimbabweans, we know KFC to be one of the highly priced quick service restaurants, or slash fast food restaurant. So now, with them being pretty much expensive, these guys are looking to cheapen their products for the general people here in Zimbabwe. Now, on a general basis, across the world, KFC is pretty much known to be a very cheap fast food restaurant where people can get very good chicken at very low prices. But then here in Zimbabwe, like I've mentioned, it is pretty much expensive, and it is not very competitive for them on the basis of them having to compete with the likes of Chicken Inn, who have an outlet almost in every corner, in major corner in the country, and Chicken Slice, which has been coming up very fast in terms of its growth.
Hold on a second. You mentioned KFC's competitors. What does this mean for the market? What does this mean for the sector?
Okay, with CBH coming in with the investment of $150 million in the poultry industry, this means that these guys are going to be able to produce as much chicken as they need for their KFC brand, making their products cheaper. Also then pushing out some suppliers who have already been supplying them and supplying other outlets, because I mean, they're not gonna only focus on servicing KFC, the restaurant itself, with the birds, but then they're also going to be looking at supplying supermarkets. They're also going to be looking at supplying other restaurants that are within the country. So with them coming in with the production level that they currently do of about 150,000 birds a year, which almost doubles what we are currently doing at 140,000. Because like you do see that our history has not been very, very bad, but then this history is not pretty good. Why? Because we also had to supplement this production with some importations from the likes of Brazil. So now with Brazil being one of the areas of our supply for chicken, with CBH now being in Zimbabwe, that means we are pretty much going to be able to knock out Brazil and forget about those guys for quite some time. So in terms of them being able to produce much more chicken, they're going to be able to reduce their prices for KFC. They're going to be able to knock out some competitors, i.e. Brazil on an obvious case, and then other suppliers that have been supplying the likes of your Spars or your Pick and Pays and the like.
Okay, but what then does it mean for the consumer?
Well, for the consumers, it's pretty much obvious. I'm going to be getting a much cheaper priced bucket of wings and drumsticks.
What is the implication of this on the small scale producers? I mean, we've got, in almost every neighborhood, perhaps in the ghetto, you find people rearing chickens and all that. What does this mean for them?
Sorry, excuse me. So, like you see here with the chart that I have, for 2018, small-scale farmers had constituted about 68% of the 140,000 metric tons of chicken that we produced. So now, with them having to face much more competition from a percentage that is likely going to be coming up, maybe 5 or 10% for large-scale farmers to come into the 40s, or even closer to the 50s, with the 150,000 metric tons of bird that is going to be coming in, they're going to face much more pressure. These guys may end up even closing some of their shops. because it's going to be much more expensive for them to produce on a small scale basis rather than on a large scale basis. Some of these have been able to actually find themselves in a better place because of some programs that were coming through Ivans that were actually funding some of these small scale farmers for them to be able to actually suffice for the gap in the supply that they were facing. So the small scale farmers are going to come into a place where they're going to feel the pressure, but then we could also look at some opportunities that could come out of CBH that are similar to what Ivans was doing, but then they may come in a place where it is going to be a little bit more favorable for them, so that they could also take out some of the pressure from them, even though they're bringing in about $150 million, which is pretty much almost pocket change to them.
You talked about opportunities. Are we talking about employment here?
Yes, definitely. Even I mean, if there's going to be more of your CBH and your Ivans giving opportunities to those that don't have employment currently to actually start rearing their own chickens, then that means more employment for them. That means more taxes. That means more money that is going to be flowing within the country and the like. And it's a very much good thing for us, because I mean, if that employment rate comes up, that means more taxes for the government. Okay. If the government is going to be getting more revenue, that means something better that is going to be coming in. But then these effects, in terms of the larger scale of the macroeconomic aspect of Zimbabwe, may be felt a couple of years later, but then it's going to kick in very soon. Because I mean, growing a bird is not that, it doesn't take that long. About 6 weeks, that's when you find a very good, juicy, succulent bird that you could slaughter and have a good dinner with your family.
Okay, fair enough. Let's move on to the stock market. How did the stocks perform today?
It was a very damp day today. This is a pretty much the representation of what happened through the week from Monday. The stocks are down about 2.19% on the all-share index. The industrials index is almost similar, coming off 2.23%. And the top 10 index is down 3.14%, although the mining index is up 0.52%. Now, we do see this kind of representation because there has been a lot of divesting from foreign investors who have been putting their money in Old Mutual, mostly because of its international recognition and its standing in different stock markets, which is dual listing. So basically, with them divesting into Old Mutual, that means that they were letting go of some of their stocks in other blue chip companies, such as your Cassavas, your Econets, your Inscores, and your Nutfoods, and the like. So you'd find that throughout the week, some of those companies did come off just a couple of percentage points. So you'd find that on a day-on-day basis, both the industrial and the all-share index did come off similarly by 1.02% and 1.03% in that respective order, for them to settle at 151.68 and 505.91 points. The minings index did come off today, also consequent to Bindura Nickel company that also came off today on the stock market. We're going to look at that a little bit later on. The top 10 index was the hard-hitting one as well, as it came off 1.43%. Like I had mentioned earlier on when I was just giving you a rundown of how the week was going on, we do see that your Insco did come off 10% today. Your Citco International, surprisingly for me, has come off 12%, because these guys are pretty much dual listed also on the Botswana Stock Exchange. Cassava did come off 1.04%. But you do find that your Econet and Delta did come up a little bit, so did your Old Mutual and Padenga. As we just move on to our rises and fallers for the day, like I mentioned, Bindura is amongst the fallers, having come off 0.47%, which is pretty much what affected the minings index, because you do see that Bindura Nickel company has the heavier weighting in that index, as to the other two companies, which would be your Wange Colliery and your Rio Zim. And then we do see that Citco International, and like we talked about, these top three guys are amongst the blue chip companies. However, Star Africa did come up 22.22% for it to set at 1.1 cents. This was actually them coming back from a loss that they made yesterday, where they had settled at about 0.9 cents. OK came up 1.42% for it to settle at 28.56 cents. I think OK has had a very positive movement today, mainly because of the inflation rates that did come up, because we do see that within the inflation rates we have a component of the food items and also non-alcoholic beverages and the like. So these guys do cater for most of those products, and that inflation rate coming up could have inspired some investors to actually put their money into a retailer, because there could be better profits that could come by half year or end of the year.
Okay, thank you, Anisu. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. From Anisu and I, thank you and good evening.